Oh my God. Reminder again that if you want your valuation for you want to get feedback on your valuation, you got to get it to me by when? A week from Friday, which happens to be the last day of this month. Okay, so until 5 p.m. A couple of things on your valuation. Have your attention, please. It's on. But make it any louder. I get too much of feedback. Couple of things on your valuation. How many of you have not started on your valuation yet? It's fine. Okay, put up your hand. You know, the most critical step in doing this is, right, getting started. Once you get started, it's a question of you can get stuck, and some of you might get stuck. And if you get stuck, I want you to step back and gain perspective, because ultimately you got to ask yourself, how much time do I want to spend on this particular number? You can always make an approximation and come back to the number you're stuck on. So my advice is don't stay stuck. And finally, I know some of you feel the urge to build your own spreadsheet. I won't stop you, but it does make my life more difficult. So I'm okay with that, because it does mean I have to check your mechanics to make sure you're not adding something which you should be subtracting. The alternative is to take my spreadsheet and adapt it. So if you feel that it's not flexible enough, you want to add an extra 5 years and make it 15 years, you want to add 3 line items to revenues, hey, the spreadsheet is adaptable. It's nothing proprietary about it. So, feel free to do that. Okay? How many of you are done with the evaluation, at least tentatively done? Hey, Yuki, what did you get as a value per share? Give me a rough number. 900 euros. Okay, so when you're done, you're going to get a value per share. So my first question today is, when you look at that value per share, is it a value as of right now, which would be what, Friday when you turn it in? Is it a value a year from now? Is it a value at the start of this calendar year? You know why I picked the start of the calendar year, right? What did you use as your financials? Probably through the end of 2022. Yeah. So it's just saying, well, the finance. Or is it the start of the next calendar year? Maybe it's the end of 2023. What do you think the answer to that is? When you do a DCF value, what are you getting? I know that it's the timing and consistencies, right? Your risk-free rate, your risk-free might be as of right now. But you're saying, what about the fact that my financials are from 3 months ago or 2 months ago? You are being consistent. You know what the consistency rule is? You're using the most updated numbers you can get for every single input. It's not your fault that accountants don't update the numbers every day. Okay? But in equity research, and I know some of you, in spite of my trying to talk you out of it, are going to end up in equity research. You know, the language that's used is they never talk about value today. They talk about a target price. So you'll see it right up there. The target price is what you expect the price to be a year from now. So you're going to be in an interview. I am an equity research analyst. I'm going to looking to hire you as an analyst. So you've taken this valuation class, but we don't use this DCF value. We want a target price. How would you convert a DCF value into an expected price a year from now? So let's say you come up with the value, $150 per share. What would I need to do to convert it into a target price? It's all in your in that valuation of all the inputs you need. What do you need to do? Right, back up. It's you've come up with the value per share. That's an equity value. So you want to first multiply by 1 plus the cost of equity, right? Because that's your expected return. Are you done then? What goes into a cost of equity? Both the price appreciation portion and any dividends you might receive. So basically, you first have to augment the price by the expected cost of equity and then subtract out the dividends, because otherwise it'll be double counting. You get both price appreciation and dividends. Today, we're going to go through that exercise. But if you can do that as a target price at the end of year one, I ask you, what will the target price be at the end of year two? End of year three? You can essentially, you can dazzle your interview saying, you want just 1 year? I can give you target price in 5 years, 10 years. It look like magic. But basically, all you're doing is taking your value per share and moving it across time. So if you valued a company 3 years ago at $50 and the stock right now is $65, you actually were very close to the right answer then, because you take the $50 and you grow them out to your cost of equity, you're at $65 right now. So remember that value is at a point in time, usually as of the time you do the valuation, but you can always move it back and forth across time by using the cost of equity as your compounding factor. So I'm going to go back to the last parts of the storytelling. You remember I ended the last session with my valuation of Uber, right? And I said, this is my story and my valuation. The reason I use the word my is I don't want any of you say I have the valuation of a company. Nobody does. Nobody has the high ground on this. You have your story, your valuation. You know what it's going to drive? My decisions. So you don't like my story? Tell your own. That is really the lesson I want you to take away from this is not my story for you to make decisions, is my story for my own decisions. I'm almost done. So finish my story. I feel pretty good about it. When you show your story to other people, what do you want them to do? Pat you on the back and tell you how amazing the story is. And if you hang out with people who think just like you, that's exactly what you get, right? You'll all reinforce each other and say, you know what, this is the way a cost of capital should be computed. And you've lost, I think, a golden chance to improve your valuation. So here's the final step. I call it keeping the feedback loop open. And let me use the Uber valuation to illustrate what that even means. So I finished my Uber valuation, June of 2014. The following week, I get a call from a site called 538.com. You heard of the site? It's Nate Silver's site. Nate Silver used to be the polling person for the New York Times, and then he split off. He created his own company. It's now, I think, owned by ABC. It's really a statistical geek site. I'll give you an example of what they do. You've heard of the hot hand in basketball? But when somebody starts shooting and the ball keeps going in, he's got a hot hand. So they say, is that true? They actually take the data and say, is it true that when somebody is actually shooting well, they continue to shoot well? So that's the kind of thing they do. So the editor of the site called me and they said, you know what, our site is not for finance people, but this is the kind of thing they would like because it's built around numbers and connects to story. You can run your post. So they take the entire post with the valuation and post it on the site. A day later, I got a call from Forbes magazine. Who reads Forbes magazine? Probably 75-year-olds with flip phones. Kind of an old person site. If you read Forbes, don't take it personally, but it is an old person site. They said, you know what, our old people really like this because it showed, because they've always been skeptical about how these tech companies are being priced. Can we carry the post? I said, be my guest. So it carried, same post, same valuation gets carried. Then I get a third call on the same day. It's from a site called TechCrunch. What is TechCrunch? TechCrunch is a digital magazine for Silicon Valley. It's read by tech geeks. They said, our people are not finance people, but they're interested in Uber. Some of them work at Uber, some of them own shares, own parts of Uber. Can we carry your post with the valuation? I said, be my guest. And then I get a final call from somebody who claimed to be running a site called the Ride Sharing Guy. I said, what the heck do you do? He said, I write for Uber drivers and Lyft drivers. You know how many of them there are right now? There are about 3 million people around the world who drive for Uber and Lyft. So this guy writes for them. He wrote about what, and he says, our drivers would really love to see this because they work for Uber, they drive for Uber. They want to see how well Uber is doing. I said, be my guest. 4 sites pick up the same post with the same valuation posted. And I'm glad I did because I get 4 very different sets of feedback. On the 538.com site, this is the kind of feedback I get. I looked at your valuation. I noticed it used the 90th percentile of the cost of capital. But the 90th percentile is 11.97%. You seem to have used 12%. Why? This is what happens when numbers geeks get too close to numbers, right? Second decimal point matters. And the reason I leave my Excel spreadsheet open is I said, why don't you go try 11.97% as your cost of capital, see what happens. And 5 minutes later, I get an email saying nothing happened. I see why you left it at 12%. Okay. Nothing learned by second decimal point questions. I spent a couple of minutes on the Forbes site and I realized it was completely useless because they loved it. They said, this is so amazing. Nothing you're going to learn from people batting the bike. Said, this is the way tech companies be valued. I skipped on. And I went to the TechCrunch site. They had 400 comments and they did not like it. Their response was, how dare you value one of ours with your D.C.F? We don't do that in Silicon Valley. So some of them were pure insults. Some of the insults I didn't even get. You DCF guy, that was one of the insults. That's it, the whole thing. You DCF guy, I said, is it good? Is it bad? Okay, I'll take it. Yeah. But after you got past the first 100 insults, the 101st comment started with an insult. And then I said, oh, by the way, I work in this data business and I can tell you how the networking, how Uber set search pricing. Remember, I'm not a ride sharing. I'm not an expert in any of the companies I've had. Doesn't stop me from valuing companies. I've known nothing about infrastructure investment, but I valued Adani Enterprises. I couldn't tell you how to build an electric car, but that doesn't stop me from valuing Tesla. But simply, there are people out there who know a lot more about almost every aspect of what I'm valuing than I do. So the TechCrunch guys, I learned a great deal about the technology of ride sharing, but I had to get past the insults. That's a feedback loop staying open. And then I went to the ride sharing guy's side and I learned some very interesting things about Uber, things I would never have learned if I just talked to the top management. In all my years of valuing companies, I've never talked to top management. You're going to see in a minute why. I heard from an Uber driver in LA, and he said, I noticed you used the 20% share of the fare as their revenue, which is what Uber told investors they kept. He said, in LA, here's what's happening. Until 3 months ago, I used to drive for Lyft. Uber paid me $3,000 to switch. Now Lyft is offering me $5,000 to switch back. I feel like a free agent without a contract. By the time all of this is said and done, he said, I'd be surprised if they kept more than 7 or 8% of the fare. You know what? 5 years later, Uber leaks that their contribution margin is 7.7%. My reaction was, I knew that 5 years ago, an Uber driver in LA told me. That's a feedback loop staying open. So 2 weeks after this feedback kicks in, I'm on a trip to Europe. I'm stuck in Munich airport waiting for a flight and it's delayed. And I make the mistake of opening up my email and checking to see what the emails that have come in are. And I notice I have an email from a gentleman named Bill Gurley. Have any of you heard of Bill? He's a partner at Benchmark Capital, one of the the highest profile VCs in Silicon Valley. But Benchmark Capital was one of the first investors in Uber. They invest in Uber at a $1 billion pricing. Bill Gurley sat on the board of directors at Uber, and he was rumored to be the person closest to Travis Kalanick, who's the CEO of Uber. So let me ask you the easy question. Does Bill Gurley know more about Uber than I do? Absolutely. So I open the email. Here's how it begins. I just read your blog post on Uber and I did not like it. Okay, we got that out of the way. So I've written my own blog post to counter your blog post. It's blog post warfare, very 21st century. And he said, I've said some mean things about you and I just wanted to let you know. Sincerely, Bill. I closed the email, 2 hours left of my flight. Guess where I go next? I go to the site called Above the Crowd. That's Bill's site. He's 6 feet 6 inches tall. That is above the crowd. I must be below the crowd then. Should rename my site. And here's the lead article. You can still find it on Google search. If you type, Demodren misses by a mile. Get it? Uber driving, my GPS is not working. I kind of got it. And essentially, he took issue with every part of my valuation. He said, Uber is not a car service company. It's a logistics company. Notice how words have consequences. What does logistics cover? It covers car service, obviously. It covers delivery. It covers moving. Magically made the company a bigger business. He said it's not just urban, it's going to be everywhere. And he gave examples of suburban services. He threw in mentions of mirrors in the cars. I didn't want to read any further, et cetera, et cetera, et cetera, rural. And finally, he said, we're trying to connect up with airlines and credit card companies so that when you fly out of New York on United to Jakarta, after you make your reservation, there will be a little box that says, do you want an Uber car waiting for you in Jakarta? A very clever way of saying, we're going to take our domination in New York and translate it. It's a way of making your local networking benefits into global networking benefits. Took me 15 minutes to read the post. I was fascinated. Along the way, he took swipes at me, but who cares? I've been swiped by far worse. So I finished the post and sitting still in Munich airport, I emailed Bill. I said, Bill, it's a fascinating story. Would you want me to put a number on your story? He said, what are you talking about? I said, you told a big story about Uber. I can convert to a number. He said, be my guest. So I pull out my laptop, open up my Excel spreadsheet. And here's what I changed. Remember that $100 billion market that I was going after in my original? I replaced with a $300 billion market. That includes logistics, transportation, much bigger potential market. But that 10% market share I gave because of local networking benefits, there are global networking benefits. There'll be 3 ride-sharing companies dominating the world. They gave them a 40% market share. The value that I got was $53 billion. So still sitting in Munich airport, this is a long way. I sent the Excel spreadsheet back to Bill and said, do you like this more? He said, a lot. And he said, by the way, that 20% share of the fare, that's not long for the world. It'd be closer to 10%. I almost told him that Uber driver in LA already told me. But I said, that's easy to fix. It's an input into my spreadsheet. I made the 20 into 10 and I came up with the value of 29 billion. So how can the same company be worth 6 billion, 28 and 53? There's only one value out there, but they're all plausible stories, right? How you frame the story can lead you to different value. In fact, in December of 2014, I wrote my 5th, I milked Uber for all it was worth. I wrote 5 posts on Uber in 2014 alone. So December of 2014, I got sick and tired of people picking on my story. I don't like your growth rate. I said, finally, you know what? That's my story. You want to make it your story? I'll do a do-it-yourself valuation of Tesla. And here's what I did. I said, you pick the story. So at each stage, I would stop and say, you tell me what business Uber is in. Is it a car service business? Is it a logistics business? Is it a transportation business? Or is it an on-demand business? So what's an on-demand business? You need something in a hurry, they do it for you. You are in the bed, you're in your bed, you have to go to the bathroom, but you're too lazy. An on-demand company will come and carry you to the bathroom and carry you back. Now, it's basically whatever you feel too lazy to do, the on-demand company will do for you. I'll tell you the company that comes closest to an on-demand company. It's a company called GoCheck. It's an Indonesian company. I'll give you an example of services GoCheck offers. New Avengers movie is opening tomorrow. Lines are going to be 2 hours long. You're too busy. You're working. You can't spend 2 hours. GoCheck will hire somebody to stand in line for you. Sounds very, it almost sounds like medieval, right? You're letting slaves stand in for you. But basically, they're taking advantage of the fact that how people value time is very different, that somebody might value their time more. GoCheck will do it for you. If you get a chance, if any of you value, even if you're not valuing GoCheck, take a look at the company. It's, their ride sharing is actually guys on motorcycles and scooters. You know why, right? If you ever seen Jakarta traffic, you can get in a car. You're not going anywhere. So they go in and out. So I said, you pick and I said, do you think they have global networking benefits, local networking benefits, or no networking benefits? You pick. Do you think they have strong competitive advantages? Weak? Do you think that drivers are employed? So basically at each stage, I say, you pick. And then at the end of the process, I estimated what the value would be given the choices they made. And guess what? Depending on the story you tell, the value can be anywhere from less than $1 billion to more than 90 billion. Now, when I put this out, people said, this is why you shouldn't do discounted cash flow valuation, because you can get any value you want. That's not the way I read it. The way I read it is, especially with young companies, there can be significant disagreements about value. And those disagreements are not about your growth rate is different from mine. It's because we're telling different stories about the same company. Let's make that debate about the story. It's a much healthier debate than my saying, I use 50% growth rate, you use 40% growth rates. What does that even mean? The feedback loop is critical because it allows you to reassess your story and say, okay, maybe I should finesse this. I'll give you, it makes life a lot more fun if you're doing valuation to have a feedback loop open. I remember when I valued Beyond Meat. So when it went public for the first time, the first thing I did before I even sat down and thought about a story, I went to the local grocery store. I went to the frozen food section and picked up 3 packets of Beyond Meat. Because what's their big claim to fame? They use pea proteins to produce something that tastes insanely close to meat. I'm going to say, is that true? I don't even like meat. But I want to say, is that true? And it is. In fact, it's too much like meat. It's like gross looking meat, but it tastes, if you like medium rare, you get the medium rare feeling. Right? And I'll tell you, my moment of awakening with Uber is my original story for Uber was it'll attract people like my son and my niece, young people who don't like cabs. That's what my original valuation was. And I ended up going back to India in 2015 for something. And I went back to the home I grew up in. And my mother, who's conservative South Indian woman, now we have to go out somewhere, and she says, usually her version of going out, you open the door, the driver, bring the car out. Now, instead of doing that, she picks up a phone. It's a smartphone. I said, Mom, you have a smartphone? She started hitting buttons, and I said, what are you doing? She said, I'm calling an Uber. I said, I can't come with you. I have to go back and revalue the company. If your mother is using Uber, you got the market completely wrong, right? Okay. So if you look at my valuations of Uber, and in fact, take a look at my June 2019, you see my potential market is wide, because let's face it, Uber has changed the car service business in ways that I did not see in 2014. Bill and I are friends now because we run into each other. And I tell him, look, I'm glad you wrote that, because in my valuation, since I've learned, so my Airbnb valuation, that is the lesson I brought in using a much bigger market. But I also tell him, look, I got the margin story much better than you did, because you thought it was going to be easy to get to profits, and they haven't. So you got the growth story, I got the margin story. Let's see where we end up at the end of this process. But it'll make this process a lot more interesting if you keep the feedback loop open. That's why I spend more time with Uber drivers than I should. Because this is my research. I'm thinking of actually writing off all my Uber rides as a tax-deductible expense. I'm doing research. Come on, I am doing research, right? In fact, I use Disney in my applied corporate finance class as my lab experiment. And I spent 4 days in Disney World. Maybe I can write off everything I spend in Disney. Why did you spend $20 on that corn dog? I had to do research. This is part of my applied corporate finance class. I don't think the IRS will accept that, no? But that's the feedback loophole. So on Friday, you're going to be turning in your story and your valuation, reflecting what you think about the company. Relax, enjoy the weekend, because on Monday, things will happen, which could change your story. Generically, there are three things that can happen to your story. One is your story can break. What happens? Some event, either within or without the company, can cause the entire story to come crashing down. I'll give you the most obvious case of this. You have a small pharmaceutical company with a drug working its way through the pipeline for diabetes, and you attach a high value, expecting big revenues. And then you open up the Wall Street Journal on Monday, and it says in the most recent test of that drug, 3 people have died, and the drug's been pulled off the testing. There goes your company, right? Oh, here's another example. You heard of a company called Ashley Madison? It's a company for cheaters. People want to cheat on their spouses, you cheat with other cheaters. So it's a big cheating site. It's attached to $1.8 billion valuation, lots of cheaters in the world. And then something catastrophic happened. Does anybody know what happened? They had a data leak. You know what happens when your business is built around the cheating business and the data leaks? The 1.8 billion became 300 million all of a sudden, because some people stayed on because to them this was actually good. They wanted the world to know how big they were at cheating. So we're the biggest cheaters. Look, I have 15,000 episodes. You wouldn't have cared, right? This is but Ashley Madison, big-ish. That's a story break. You can have your story shift. What does that mean? Your basic story stays the same, but the contours of the story change. Revenue growth might go up, margins might change because of things happening around you. I've told pretty much the same story in valuing Apple between 2012 and 2021. And my story for Apple is it's a slow-growing cash machine. Let me give you both parts of the story. When you look at Apple as a company, where does the bulk of its value come from? What does it produce? What product does the bulk of its value come from? 75% of its value comes from the iPhone. So if you got that MacBook Pro and you're wondering why they spend so little time on you, this has become almost a side game for them, right? You're saying, so what? 10 years ago, the smartphone business was a growing business because people were shifting away from flip phones to smartphones. Those days are done. The slow growth is coming from the fact that they're one of the two big players in the market, Samsung, and if you include Androids and their different manufacturers, you're not going to get 20% growth in the business because everybody has a smartphone, and you either have to get somebody with an Android phone to switch to you or get somebody to upgrade, and you're not going to get that 20% growth. Slow growth. Why cash machine? Because I think, when I look back at all of the products I've looked at over time, no product has thrown off as much cash flow as the iPhone is. I'll give you an example of how much of a cash machine it is. Apple has bought back $500 billion in stock buybacks in the last 5 years. $500 billion. And while doing it, they increased their market cap by $1 trillion. You know how difficult that is? That's like chopping off pieces of your body and becoming fatter at the same time. How do you do that? That's what a cash machine will do for you. They can't give the cash back fast enough. But that doesn't mean my valuation stays exactly the same, but it doesn't shift dramatically. The story stays roughly the same. Your valuation can't shift. So what could cause my Apple valuation to shift? Something dramatic. And Apple Watch can't do it. You see why? The collective total market for the Apple Watch, even if everybody had an Apple Watch, is like 100 billion. When you're a $2 trillion or $2.5 trillion company, having a market of 100 billion is like penny change. You got to have, so once you get to the size of Apple, you can already see to get high growth, you have to go after a really big market. And many of those big markets are markets that Apple doesn't want to go into. It doesn't want to be in the electric car market. It's a nasty, messy manufacturing market. Do you think Apple's heart is in the entertainment business?
Because what's it's good. The Apple streaming it's actually it's a really good streaming, but you can see the heart's not in it. You're not sure why they're even doing it. Clearly it's not going to create the value that changes the value of $2.5 trillion. I'm sure there's some insidious plan in the long term, but I'm too tired to think about what that plan might be.
So I keep looking when I look at Apple. The only business that's kind of altered a little bit my story for Apple is the growth of the Apple services business, which is everything that flows through the App Store is incredibly profitable to Apple. It's in fact the reason that who is it they had a problem with, which Fortnite I think had they had to pull the game off because Apple takes a slice, a big slice, 30% of everything that goes through the store. So story change, you got basic story the same, but the contours could shift. But you can also have a story shift where a company does something and you say, really? I didn't think it could do that. I'll tell you what could change my valuation of Tesla. If next quarter or the next year they report they got $500 million in revenues from robots, right? That's in fact the Tesla bot is something that they've introduced in their own factories and in businesses like manufacturing and mining with a lot of repetitive work, a robot might actually do. That could change. That's a big business. It could potentially alter the value of the company. So what I'm trying to say is you get a story, you get a valuation, but you're keeping your eye open for what could change that story. Story shifts, story changes, and story breaks. Any questions on storytelling? Okay. Well, how many? 50? This is session 15 of the class, right? It is session 15. I know. I just wanted to see whether you're more than halfway through this class. Right? How many companies have we actually valued in this class? That's a valuation of the week, not in class. We haven't valued a single company yet. You should ask for your money back, Christian. I don't know whether NYU does this. You're saying, I took a valuation class, we valued no companies in class, right? So I'm going to remedy that. Part of the reason I had to wait is if you don't lay the groundwork, then jumping into valuation too soon is the most dangerous thing you can do. So what I'm going to do is actually value companies and I'm going to lay the groundwork. As you go through these valuations, and you're going to see about 20 to 25 companies being valued, you're going to see equity risk premiums come out, and they're going to keep changing. Why? Because depending on when I did the valuation, the equity risk premium reflects the equity risk premium as of that point in time. So pre-2000, pre-1998, I used to use a lot of 5.5% premium. Some of you noticed this when you looked at the old quizzes, 5.5% premium. That shifted down to 4, shifted up to 6, and it'll keep shifting depending on when I do the valuation, usually reflecting the implied premiums as of that point in time. So when you compare the valuations and you say, why the ERP is different in every single valuation, it's because they were done at different points in time. Second, with each company, I'm going to introduce the valuation with a story. Why? Because I want to stay true to this notion that every valuation is story. So I'm going to tell you the story I'm telling for the company and then use that story to come up with the inputs that drive the valuation. So let's start simple. Let's put training wheels on. I'm going to start with a really simple company to value. Company's called Con Ed. No, Con Ed does. What does it do? Once in a while, they forget Brooklyn and there's a power outage, but most of the time they provide power to most of the city. Now, all these lights are Con Ed lights. It's a regulated utility. What does that mean? It's a regulated monopoly, actually. And they're the only game in town. Now, of course, you have all these other companies that claim, but they're not very recently, only game in town. Con Ed or Con Ed? They're Con Ed. Now, usually as a monopoly, what you worry about is price increase. So regulate in terms of the pricing. And how does the regulatory commission decide whether to grant them a price increase or not? What do they look at? They look at the return on equity Con Ed makes and actually compare to the cost of equity. This is the one business where cost of equity, remember the risk-free rate, beta risk premium, actually have consequences. And they try to make sure you don't earn more than your cost of equity. That's the regulated monopoly part. And how quickly is New York State's population growing? It's not. It's a mature part of the country in terms of population size. This is all going to lead into what I'm going to do. I'm going to value Con Ed as a stable growth. Why? Because it's not like power usage is going to go up 10, 15%. They can't afford it. They don't have the capacity to even, they'll actually talk you down if you try to use up too much power. In fact, when you have really hot days in the summer, they try to convince you, don't, please don't use your air conditioner. It might blow up the system. We don't want to build another plant to cover this. So almost they don't want the growth. So the growth is going to be low because you're catering to a population that's pretty stable. But I'm going to value them not just as a stable growth company, but I'm going to value them as a stable growth company using a stable growth dividend discount model. You know, the nice thing about a stable growth dividend discount model is there are only three numbers you need: expected dividends next year, cost of equity, and the growth rate. You're saying, I think I'm going to use a stable growth dividend discount model for my company. This sounds easy. Before you use it, though, you got to pass some tests to make sure it is a company. So with Con Ed, here the tests are right. First is this company paying dividends like a mature, stable growth company? What am I looking for? I'm looking to see whether the payout ratio is high enough to be compatible with. If I see a payout ratio of 10%, I know already a stable growth dividend discount model is not going to work because this company is not behaving like a mature company. In the case of Con Ed, that percentage is 73%. So Con Ed is paying out 73% of its earnings as dividends, which means they're reinvesting 27%. Remember the fundamental growth equation? Take the retention ratio, multiply by the return equity. And because Con Ed almost by regulation earns its cost of equity, the return equity of 7.7% is set equal to the cost. The expected growth you get is 2.1%. I think I can use that as a stable growth rate. How do I make that judgment whether that growth rate is okay? What do I compare it to? Or the risk-free rate, right? Remember we said the risk. So in this case, you look at the 2.1%, 4.1% risk-free rate using a 2.1% growth rate in perpetuity is going to be. So they're paying dividends like a mature company. They're growing at a rate less than the growth rate of the economy. Final question to ask is their beta and cost of equity compatible with a mature company? What does that mean? If I see a beta of 1.8 and a debt ratio of 92%, I'm going to hold back and say maybe there's something they need to fix first. That wasn't the case. In the case of Con Ed, they had a beta of 0.8 and a cost of equity of 7.7%. Okay, I think I can use a stable growth dividend discount model. I take the expected dividend next year, $2.32 is the dividend in the most recent 12 months. I grow it out 1 year at 2.1%. Why? Because every present value equation needs cash flows 1 year out. And I divide by the cost of equity, 7.7% minus, I'm done. That's the value per share. Value per share is $42.30. The stock is trading at $40.76. Am I surprised that the value is close to price? This is as close to a bond as you're going to get in the stock market, right? It's a big dividend-paying company with low growth. I'm not surprised, but I'm still finding the company to be slightly undervalued, right? So let's take what that exercise we did at the start of the class about what will the price be 1 year from now. The value per share for the company is $42.30, right? That's my discounted cash flow value. If I asked you what the target price will be 1 year from now, somebody lead me through the process, even if you can't give me the number. What am I going to do? I'm going to take the $42.30 and which is 7.7%. So 4230 times 1.077. One final step. What's the last thing I need to do? Minus the expected dividend, which is what, 232 growing at 1.02 or 2.1%. I'm going to come up with like $44 and something. So if you want, you can check it on your calculator. So basically, I'm taking the 4230, growing it at 7.7% and subtracting the expected dividend. So let's say I come up with 4430. People often say, well, if my stock price is 40.76 and I'm buying it at 40, that doesn't sound like much money. It's only $1. But if you go out and buy the stock now, you're going to pay 40.76. If you actually end up with $44 and something, which is what you should if your value is right, you're going to end up with a return of about 13% on Con Ed. And if you can make a 13% return on Con Ed, you're way ahead of the game. So if you want to convert discounted cash flow values to target prices, you have the mechanism in the spreadsheet to do it. In fact, add an extra line if you want to the spreadsheet and get expected target price in year 1, year 2, year 3, because it's very doable with the cost of equity right in front of you. Any questions on the target? Now, even with a company where everything seems pretty stable, easy to predict, as Conrad, I could be wrong, right? My growth rate could be wrong. My discount rate could be wrong. Expected dividends next year might be a little too high or low. When you do a valuation, you can solve for any input you want to make the value equal to the price. In other words, you can reverse engineer your discounted cash flow valuation to deliver. It's like solving for any number. Like usually we solve for a discount rate, call that the IRR, but you can solve for any input you want. In this case, one of the things that I did was I did change the growth rate for the company to see what growth rate I would need to get to the stock price trap. It's called an imputed growth rate, but you can then use it to decide how much buffer you have in your estimate. So this is an easy valuation. Mature, slow growth company paying 73% of its earnings as dividends to come up with the value per share. I was looking through the list of your companies, and NAG, if you haven't entered your name, there are about 50 of you who haven't put the name of your company in, which either means that you haven't picked a company, which terrifies me, or you picked a company and you're ignoring me, which pisses me off, or you picked a company and you entered it in there and it got removed by somebody else in the class, in which case I'm paranoid at this stage. Whatever it is, go fix it. Put here the name of your company. And I was looking at the list, and I don't think very many of you are going to be able to use a stable growth dividend discount model. But the second company I'm going to value is going to be a little more difficult, but not that much more so. It's a company called 3M. What does 3M do? Incredibly boring things that make a ton of money. Like that amazing Post-it note. The guy who invented this, can you imagine? I mean, if he actually got the claim in every Post-it note bought, even in this digital age, look at how many Post-it notes there are. But boring. So this was a valuation I did on September 12th of 2008 during the day. I said, what do you mean during the day? What do I care when you do it? You know why I picked September? Why September 12th was a significant day, right? After close of trading on September 12th of 2008, Lehman Brothers came out with the news release that they were in deep trouble. They were looking at Barclays buying them out over the weekend. Barclays never bought them out. And on Monday, we woke up to the 2008 crisis. I would love to tell you that I saw it coming. Not even on my horizon. Maybe Nouriel saw it coming, but he sees it coming all the time. You know, Nouriel Rubini is looking out his window. He sees a crisis coming, Bitcoin collapsing. But he's like Eeyore. He sees crises around every corner. So I value the company completely oblivious to the storm approaching. This is nice. So the story I was told for 3M in 2012 is this nice, solid company with products that deliver incredible returns on capital. I think the return on capital they had was close to 25%, growing at a reasonably high rate given the size of the company. Not about particularly, so it was an easy valuation. I plugged the numbers and I came up with the value of $83.65. By itself, there's nothing particularly interesting or difficult about this valuation. This is one of those valuations we could just take Excel spreadsheets and project them out and come up with $84. Then I went home that day. And I come back on Monday, of course, the world is falling apart. So 2 weeks later, I'm valuing 3M again. None of the numbers for the company have changed, the same financials, but the world around me has changed. There's this canard that intrinsic value is timeless, that somehow once you value a company, it can't change. What absolute nonsense. Because when the world changes around you, your intrinsic value will change. And in a crisis, what are the first things that are going to shift? Your risk premiums. The equity risk premium of 4.5% that I used before has now become 6%. The default spread I used before has gone up, not because the rating has changed, but because the price of risk in the bond market has changed. Cost of capital has changed because we're in a crisis. And as this crisis unfolds, it's quite clear that it's going to bring the economy down too. Will that affect 3M? Yes. People will buy fewer Post-it notes. Why? Because you don't have a job. What the heck are you posting about? You know, might as well sit at home, stay in bed, don't get out. It's kind of depressing, but no, that's what you're going to do. It's not going to be huge, right? Maybe some people need the Post-it note and they get depressed. They write more and more notes to themselves. They don't be depressed. They do things. So but the growth drops off. So think about the effect. Same company 4 weeks later, in a crisis, I use a higher discount rate reflecting the higher price of risk. Lower growth rate in perpetuity, risk-free rates have come down, and a lower growth rate. The value that I get per share is $61. Think about it. I've taken the same company with the same numbers. In over 4 weeks, the value's gone from 84 to 61, not because the company has changed, but because the macro environment has changed. Here's my prayer for you, that you don't face a crisis like this between next Friday and May 8th. But if you do, you know what you need to do, right? Because don't do what most people do, throw up their hands and say, I can't do a thing, it's a crisis. It's actually relatively easy to adjust for a crisis. It just means go in and adjust your risk premium. It's an input. So, use a risk premium that reflects the fact that you're in a crisis. You have a higher cost of capital. If you're in a crisis, the T-bond rate might drop, but remember that has ripple effects on your growth rate in perpetuity. Now, be willing to adapt when things change around you because your value per share will change. Okay? It's a good exercise to go through, if nothing else, to allow you to see how macro variables affect. And now, how many of you are valuing banks? Anybody? How many are valuing banks here? Anybody valuing a bank? Nobody wants to admit to it. Okay. But it doesn't have to be Silicon. It could be any bank, right? Silicon Valley Bank, of course, is a disaster. But if you're valuing JP Morgan Chase, what happened at Silicon Valley Bank is going to have an effect on your valuation in good ways and bad ways. What are the good ways? Doesn't even have to be Silicon. If you're worried about small and regional banks, guess what? You're shifting your money into big banks. So there is an argument that big banks are going to see an inflow of deposits. The bad news is this is going to come with new regulations and restrictions on banks. So that might have to come into your capital requirements and how much your return equity is. So if you're valuing a bank, over the last week, your value has shifted for no fault of your bank, but because the world around them has changed. We'll do one more valuation to kind of clean up this process. So I valued 3M, I valued Con Ed, they're both companies, right? Can I value the S&P 500? Can I value an index? Does an index have cash flows? Yeah, if I bought the entire index, you can buy an index fund, I get cash flows. Does the index have growth? The companies in the index grow. Does the index have risk? It's actually easier to do it for an index because its beta is going to be pretty close to 1 if it's an index like the S&P 500. So what I'm going to do is take the S&P 500 and try to value. We're going to do some market-wide valuation. Why would you want to do that? You want to answer the question, is market overvalued or undervalued right now? It's something I don't try to do because I'm not a market timer, but I want to give you the tools to be able to do it. So let's set the table up. This was in September of 2022. Inflation had now become this leading player in the game. The index was down, and I wanted to see whether the index was under or overvalued given all the macro news. So as I looked at the basic index, here's how I'm going to build up to. To get my expected earnings in future years, I'm going to start with my base year earnings, and I'm going to apply a growth rate. This is very similar to what I did with the implied equity risk premiums. If there I was solving for the equity risk premium, here I'm going to try to value the index. So I get expected earnings. Then I also have to estimate what percentage of the earnings will get paid out as dividends and buybacks and discount them back at a cost of equity, which will have a risk-free rate and an equity risk premium. You say, where's the beta gone? It's the S&P 500. There's no beta. Beta is 1. So there are 5 inputs in here, right? I have earnings, earnings growth, percentage of earnings that will be paid out as cash flows, a T-bond rate, and an equity risk premium. Every story you tell about markets has to flow through one or more of those 5 variables. So here were the big questions in 2008. I'm sorry, in September of 2020, September of 2022. The way I'm getting estimates of growth is I'm looking at what analysts are predicting the future. And by September of 2022, there was talk that a recession was coming. So the big question is, are analysts incorporating the expected effects of a recession sufficiently, or are they overestimating growth? So that's the first question. Second, with inflation becoming a bigger player and things becoming more uncertain, are companies going to return less cash? To give you a sense, in 2021, US companies returned about 90% of their earnings as dividends or buybacks. Why so high? Because they felt pretty good about themselves. They felt the economy was nice and predictable. But if they feel the economy has become more unpredictable, maybe they'll pay less. So that's the second question. Third, as inflation rises or falls, what will happen to the T-bond? Notice how I didn't phrase the question. I didn't say, well, the Fed meets and decides. I don't care. If inflation is going to be the big driver, I want to think about how it will play out. And finally, given that higher inflation usually goes with more uncertainty about inflation, what will that mean for the equity risk rate? Those are the four big questions. So let's start with the earnings question. So these are the earnings estimates that analysts were projecting for the S&P 500 and the percentage change in those earnings estimates. So basically, I'm saying how much are analysts weighing? Because we started 2022 with nobody talking about a recession. By September 2022, everybody was talking about a recession. So I wanted to see how much analysts were building that into earnings. And the answer was not much. If you look at the changes in earnings, we started the year at 223.34. By September, it was up to 225.34. And you can do that with changes both for this year and the next year. Analysts didn't seem to be in the same room as the people claiming to be making that there was going to be a recession. Either the analysts are wrong or the macroeconomists are wrong. And for the moment, I'm just setting that on the table. Second, if you look at how much of those earnings get returned in dividends, this looks at the percentage of the S&P 500 earnings that gets paid out in dividends and buybacks over time. So in 2001, US companies, that's the dot-com bust year, returned about 41% of their earnings in dividends and buybacks. Across the entire period, that statistic is about, if you look at the percentage that's paid out, has been about 83%. So over the 2000 through 2022 period, US companies have returned about 83%. And in 2021 in particular, the most recent year, they were up to, so if you look at by quarter, they were at about 80%. So companies seem to have settled in returning 80 to 85%, perhaps even as high as 90% in some years, because they feel comfortable. Third, if you look at how this plays out in the story, and this is my S&P 500 story. Again, it's not the S&P 500 story. So if I would, in September of 2022, my argument is analysts are underestimating the impact of a recession on earnings. The earnings are going to be lower than they're projecting for whatever reason they seem to. So I'm going to use earnings that are lower than the analyst estimates. I do believe that companies can't afford to continue to return cash the way they were in the 12 months leading to September of 2022. Why? They're returning almost 90% of earnings as in dividends and buybacks. With higher inflation, more uncertain inflation, I'm going to assume it's going to be about 80%, and it's going to happen over time. I did assume that over the long term, the equity risk premium would converge around 5%. 5% if you think about my long, you remember that graph I showed you for the implied premium going back all the way to 1960? The average is about 4%, but I think we're going to end up around 5%, which is close to what it's been for the last 20 years. And finally, I made the assumption, and this is what you need to do. This is why I don't like to value indices, because you have to make macro assumptions about inflation and interest rates. But there's no choice. I have to assume that inflation will steady at about 3.5%, which will lead me to a T-bond rate of 4%. I valued the index with those assumptions. The value that I got for the index was actually pretty close to where the index was then. I came up with an index value of 35.15. Put differently, analysts might be over-optimistic. They might be biased upwards in their earnings, but guess what the market is doing? It's incorporating more realistic assumptions about earnings. So don't mistake analysts for the market. There's this amazing thing that seems to happen. You take 100 crazy, dumb people, you put them in a room, that collective wisdom that can emerge from that room. Sometimes they all go crazy anyway, right? Because stupidity averages out, it cuts in both directions. People assume stupid things in both directions. It's one of the law of large numbers. That's why you trust your Yelp reviews, right? But let's face it, if you individually met any of those reviewers, you're saying, what the heck am I doing listening to this person who's never eaten Chinese food telling me this is the best Chinese food they've ever had? But you get 1,000 people who've never eaten Chinese food, the average across the 1,000 people seems to be amazing. It's crowd wisdom. Crowds can also go crazy, but crowd wisdom. So markets are far smarter than individual analysts or even analysts collectively, and that's what
So if you want an update, I have a January 2023 update of my valuation. But the bottom line is this value is a function of my assumption, a function of what I'm assuming about what will happen to inflation and what will happen to the economy.
So this table, actually, what I did was I essentially took, what could happen to earnings with a severe recession, a moderate recession, or no recession, and what could happen to inflation. So what's your most benign scenario? That inflation will go back down to 2%, and that the economy will not go into a recession, in which case the value you get for the index could be much, much higher, especially if equity risk premiums revert back. Every statement here about markets is a conditional statement. Implicitly, you're making assumptions about risk-free rates and risk premiums. And that's one reason I don't try to time markets. There is nothing special you or I are going to bring to the table when you're looking at the S&P 500. You value an individual company, you might say, look, I've done research, people might be ignoring this. What the heck can I come up with on the S&P 500 that the crowd already hasn't assessed? That's at the core of, do you want to time markets or not? Can I value in markets? Yes. Will I act on those valuations? No, I don't feel there's anything special that I'm bringing other than an understanding of why markets are where they are. But if you want, you can download that valuation spreadsheet for the S&P 500 and play games with changing the inflation rate, changing the economic growth rate, and see how it plays out. So now we're going to approach what I call the dark side of valuation. Of all my books, this is the title I like the most. It's a book that I wrote in 2001, before the dot-com bust, at the peak of the dot-com boom. And I'll explain in a minute why I call it the dark side of valuation. But to understand why I call it the dark side, I'm going to go back to the start of the class. I said in every valuation, there are 4 questions you try to answer. Now, what kind of company? First is, what are my cash flows from existing assets? When you look at the existing income statement, balance sheet statement of cash flow of the company, that's the answer you're looking for. What are my existing investments ranking? That's the easiest of the 4 questions to answer. Second question is, what is the value that is added or taken away by future growth? Why did I phrase the question that way? Why did I just ask you, what's your future growth? Because growth is a mixed blessing, right? Higher growth pushes up my earnings and cash flows. Higher growth comes with reinvestment. The net effect is what will determine. This is a much messier question. It's not just estimating a growth rate, but the reinvestment that goes with that growth that will tell you whether there's value added or not. Third question I'm going to ask is, how risky are the cash flows? I didn't ask you what's your beta. Beta might be your mechanism for dealing with risk, but don't mistake models for ultimate big pictures. Even if you don't believe in the CAPM and betas, you still have to deal with risk. How risky are your cash flows? And finally, when will your company become a mature company? Why do I need that question? What does it allow me to do? What is a mature company? You can use the terminal value calculation. The growth rate is less than the growth rate of the economy. So I'm going to state the obvious. When those questions are easy to answer, valuation becomes easy. When those questions are difficult to answer, this is so obvious. Why are you even wasting our time telling you that? When you take a company like Coca-Cola, what makes it easy to value? You take those 4 questions, you have lots of information on cash flows from existing assets. Assessing the value of growth becomes easy because you know what they do, what their competitive advantages are. You have lots of history for risk. They're close enough to being mature companies. Can say it happened in year 3 or 5. In contrast, we're valuing Snowflake. Those questions all become messy. So the dark side of valuation happens whenever you're valuing companies where these questions become difficult to answer. So let's look at some examples. Valuing young companies. Take those questions. You can already see why asking and answering those questions is difficult. How about companies that don't fit the accounting mold? No, pharmaceutical companies. What's the big deal? R&D, which is a capex, is treated as an operating expense. I have to remember all that the process we had to go through to capitalize expenses. And finally, companies that face significant truncation. What is truncation risk? Now, when you do valuation, you estimate cash flows in year 3. You wonder, is my year 3 cash flow going to be right or wrong, or how wrong is it? You know what truncation risk is? Will there be a year 3? Kind of scary, other dimension, right? You see why First Republic is so difficult to value? It's not that you can't project dividends for the next 10 years. You don't even know whether there'll be a next year. We're not very good at valuing companies which are distressed. We're not very good at valuing companies that can be nationalized because there's truncation. So let's start with the, as you look through, here's what I'm going to do. I'm going to go through the list of companies I'm going to try to value, trying to capture companies in the dark side. First, I'm going to start with looking across the life cycle. I'm going to start with young companies, including startups. What makes them difficult to value? Why these questions? How do we deal with it? Next, I'm going to move on to mature companies that are in transition. You know what I mean by that? If a mature company is trying to become different, it's trying to do something different. How do you deal with the changes that are coming? And finally, I'm going to value declining companies. And these are the companies where after you value them, you feel like you need to take a shower. Bed Bath and Beyond, you value the company, you need multiple showers. You just feel, no, I don't really feel depressed. But somebody's got to do the dirty job. We'll value declining companies. I also want to talk about what makes emerging market companies trickier to value. And finally, I want to talk about sectors. Are banks easy to value? That's a stupid question. Now you think, you know what? In 2005, when I wrote one of my valuation textbooks, I had a chapter on valuing banks, and I started with a sentence I have never quite lived down. Valuing banks is easy. That's how the chapter starts. It was built on a premise. It was built on two premises. The first premise is banks were run by sensible people. And the second is that banks were covered by regulatory authorities who would stop banks from doing really stupid things. You see why it was 2005. That illusion lasted until 2008 when we woke up to a nightmare of the banks are run by some of the least sensible people on the face of the earth. And the regulatory framework doesn't seem to work. So I'm going to tell you how I used to value banks before 2008, how I value banks after 2008, perhaps how I need to revalue banks after 2023 with the Silicon Valley Bank experience in mind. I want to talk about valuing commodity and cyclical companies. Even the most mature commodity companies, there's volatility, right? Earnings go up and down. What causes ExxonMobil's earnings to go up and down? Price of oil. It's a macro factor. Cyclical companies the same way. So I'm going to talk about valuing those companies. And finally, companies with intangible assets. We talked about capitalizing R&D. I want to show you the implications of capitalizing R&D on the value of a company like Angel. So we have a lot on our plate. Let's get the process started at least. I want you to be an entrepreneur, and you've just created this young company. It's a startup, lots of promise. You ready? So you're the entrepreneur. I'm going to come and ask you the 4 questions. Here's my first question. What are your cash flows from existing assets? What's your answer going to be? What existing assets? I don't know the chair. I said it. Maybe that's the only thing of value in the whole place. It's what those Herman Miller chairs that you bought. You took your entire book equity, you invested in one chair, you have a comfortable place to sit. Good. Answer the first question is, I don't have any cash flow, no existing assets. So that was easy. Then I ask you, what's your value from future growth? You say, a lot. You say, can you be a little more specific? Not really, right? You don't have to even pick a product. You don't know what the market is. Then I ask you, how risky are you? You say, very. But beyond that, what can you show me? There's no beta, no history of earnings, nothing you can show. So when will you be a mature company? You fall out of the chair laughing. You don't even know whether you'll make it through next week. You have no cash to meet payroll. Now do you see why most people don't even try to value young companies? Every input becomes this exercise, and I have no idea. And let's make this even worse. Let's suppose you're a company in a sector where every other company looks just like you. You're all young companies. You're all small revenues, money losing, no business models. It's what I call the valuation trifecta. Here's what you get, right? Because think about the places you go or you've gone already to value a company. What's the first thing you pulled up as raw material to value a company? 10K, annual report, financial statements. And then presumably because you have access to capital like you pulled up data on the sector or you looked at my margin. So basically you looked at industry averages. So you look at the company, you look at its history to see what it did during the last recession, you look at comparables. One by one, I'm going to knock your crutches out. Let's suppose you're a young company, so you don't have much history. It's a young company very early in the life cycle. Current financials tell you very little. And then you look at the sector, and they're all companies just like yours. They're all young companies early in the life cycle. This is when the dark side will beckon. You know, the dark side will say things like, valuation doesn't matter in this sector. And you start sounding like Kathy Wood. And I ask you, why should I buy the company? You talk about how big the market is. Why should I buy Tesla? Electric cars. Everybody's going to have an electric car. Why should I have Facebook? Well, my daughter's on Facebook all day long. I say, what does it have to do with whether I should buy Facebook or not? You tell macro stories. Every time I ask you about the company, it's a macro story. Why should I buy this? Artificial intelligence? I don't even know what to do with that. Macro stories. I remember when Alibaba went public, and I valued it as the China story, because it was really the China story, a company that essentially, if you think about why Alibaba beat out eBay and Amazon in China, it basically understood that what worked in the US and Europe would not work in China. In fact, I think the best description I saw of Alibaba when it went public was The Economist described it as the bazaar, the Chinese bazaar. Now, have you seen when you open up Google, you know what the page looks like, right? Simple, clean, one box, nothing, because that's the way it's supposed to be. Have you ever been in a bazaar? Bazaars are anything but simple. It's people yelling at you in 70 different directions. Come on, I'll give you a 50% discount. All prices are negotiable. If you grew up in Asia, you grew up with bazaars. If you get a chance, open up the Taobao opening site. Put on sunglasses before you do, because it'll be like bang in your face. But in a sense, Alibaba said, this is what Chinese consumers want, is they want a bazaar. And they created Alipay because they discovered that Chinese consumers were a little reluctant in those days to leave credit card information on a site because they're afraid you'd rip them off. So when Alibaba went public, I described the China story with all the pluses. It had 75% of all online retail traffic in China, went through an Alibaba site. So I valued it as an Alibaba, as a China story. I gave it high, reflected the revenue growth coming from the Chinese online retail market growing. And I came up with a value of like 160 billion, which I thought was it's the largest value I've ever attached to a company going public at the time of going public. So I put the valuation up, and then CNBC calls and says, Alibaba is going public tomorrow or 2 days from now. Will you come on and talk to us about it? And they never told me. And until I got it, there's a room called the green room, which is neither green nor a room, but this is like the terminology that they use. You come and wait there. At some point in time, it must have been green in a room. But you go to CNBC, they make you wait there. I sit there, and this guy walks in, and he's an equity research analyst. I've seen him on TV before. He says, "What are you here for?" I said, "Talk about Alibaba." He said, "Oh, that's a coincidence. I'm talking about Alibaba too." So, okay, we're probably both on the same panel. So they asked me first, and I go through this process, China story, and I say 160 billion, I have governance issues, but this is what. And he says, no, it's got to be at least twice that number. Yeah. Then I said, why? He said, it's China. And I said, can you be a little more specific? There's China in my story too, but this is the macro story. It's China. So let's double the number. Today, they might halve the number because depending on the point in time, they worry about it, they add value to it. That's a macro story. Second thing that happens is they talk about paradigm shifts. You know what that means? I basically can't explain what's going on, so I'll call it a paradigm shift. I've heard in my 40 years in finance, I've seen 7 different paradigm shifts, none of which actually stuck. And finally, you're going to see metrics you've never seen before. Like what? When .com companies took off, none of the traditional metrics worked. Price earnings ratios did not work. Why? Because they're all losing money. Revenue multiples didn't work because the revenues were so tiny. So you know what they started using? Market value per website visitor. And about 4 years in, Mary Meeker, at that time was the equity research analyst at Morgan Stanley, said, this is so unsophisticated. Because some website visitors spend only a minute, some spend 15 minutes. We need to get market value per minute. Oh, she called it market value per eyeball. So they computed market value per eyeball for every internet company. Of course, you want the low number. And I still remember looking at those numbers and saying, what do I do with these numbers? How do I know it's high? $300 per eyeball. I really like my eyeballs. I would definitely pay at least $300. But you can see when you create these metrics that you've never seen before, you have no frame of reference. If I ask you to pay 500 times revenues for a company, you're going to balk, right? Say that's a high number. 5,000 times earnings. No, I'm not doing it. $300 per eyeball. Oh, you know what? That sounds low. Let me just buy it. That's the downside. So every time in the 1990s, I used to value companies. I used to do my valuation seminar. Somebody would come up to me very aggressively at the end of the session. You really can't value Amazon.com using a discounted cash flow model, can you? And the finger going like this, step back. You're going to hurt me. At the risk of grave personal injury, I'd say, yes, you can value Amazon with a discounted cash flow model. They'd give me this look of total contempt. Academic. It's not a compliment. Academic, basically, you really can't do this. You can just talk about it. And after about the 5th or 6th time of being called an academic, I got really pissed off. I actually sat down and valued Amazon.com in 1997 for the first time. And I kept a journal of my experiences of what I felt and what I had to deal with at every step. It's still on my website. It's called The Dark Side of Valuation. Can Amazon.com be valued? That, of course, became the book 4 years later about valuing.com companies. And the second edition and the third edition have come out. And basically, I've discovered the dark side lurks anytime you face a lot of uncertainty. I'll wager that right now, equity research analysts whose job it is to assess banks are kind of thrown up their hands. Because that's what happens, the dark side. You throw up your hands because you say there's too much uncertainty. I can't deal with it. Ask me again in 6 months. So what do I do for the next 6 months? So I'm going to take you back to January 2000 and take you through a valuation I did of Amazon in January 2000. And as you look at this valuation, it's not fair using the benefit of hindsight because you could say, oh my God, he got those numbers. Of course I got the numbers. Absolutely wrong. But I'm actually going to show you my comparison of what my projections were in 2000 to what actually happened over the following 10 years. I seldom do this because it can create psychological trauma to actually look at your forecast and the actual numbers, but I'm going to do it anyway. So this is the valuation of Amazon January 2000. I actually did this for, I don't have a CFA, but I've been giving the keynote to the CFA for like 30 years. I don't want a CFA. But this was one of the first webcasts that they did and say, can you do a webcast for our members on how to value .com companies? They said, okay, I'll pick Amazon. So let's lead into the valuation. In January 2000, Amazon was a company with $1.1 billion in revenues. So let me pause right there. A US retail company is $1.1 billion in revenues. It's tiny revenues. Just to give you perspective, what were Walmart's revenues last year? 500 billion. And in 2000, Walmart's revenues were 150, 200 billion. Gap at 20 billion. I mean, basically, 1 billion is tiny revenues. And operating losses of 410 million. So this is a company with small revenues and big operating losses. So you ready? Here's my question. Can a company with small revenues and big operating losses become a valuable company? It's an easy question, right? Yes. So let's say simplistic. What has to happen to the small revenues? They have to become big. I told you it was simplistic. What has to happen to the losses? Not just smaller. They've got to change signs. If they don't change signs, you're in big trouble. So the minus has to become, this is so simplistic. So basically, what are the first two big assumptions valuing on companies? Revenue growth, because you got to make the small revenues into big revenues. I'm giving you the roots of the FCFF simple Genzu spreadsheet.
because that small revenue becomes big revenue to revenue growth, and a target margin. I know you're not going to get there next year, of what you think your company can make once it gets past the pain. Here's my revenue growth, 42% compounded revenue growth rate every year for the next 10 years. I remember when I was doing this as my webcast, I hadn't even finished saying 42% when they had emailed the question, the old technology. And the first email question comes in, how come you're being so pessimistic about future growth? I said, pessimistic? I'm taking $1 billion in revenues and making them $40 billion by the 10th. I'm increasing the revenues 40-fold. And I'm being accused of being pessimistic. You know why they thought it was pessimistic, right? What were they comparing the 42% to? The growth in the most recent year, which was 200%. So how are you dropping it? I wasn't dropping. They missed the compounded in the 10 years. The compounded growth rate is 42%, but if you look at the actual revenue growth, it starts at 150% and it scales down. Why? Because as you get bigger, you can't maintain those growth rates. I thought and I talk about why 42%, why not 45, why not 36? So small revenues, big revenues. Half my job is done. I made Amazon, at least on my spreadsheet, a big company in terms of revenue. Second, I had to pick a margin that they would have in steady state. You say, why don't you just look at online retailer margins? You know what that number would have looked like, right? They're all negative. So I said, look, online is not a business, retail is a business. The business that predates Amazon, it has fundamental economics you cannot change. I looked at the 75th percentile of regular retail companies and said, you know what? Amazon might have a lower cost structure. Their margins are going to converge on 10% over time. Right now, the margin is minus 36.7%, but over time, that's going to become 10%. So as you go from minus 36 to plus 10, it's almost magical. I've made this company go from being a small money losing company into a large money making. See the amazing things you can do on spreadsheets? Why would anybody want to run a real company? Just do it on a spreadsheet. You can make your company the biggest company ever. But there's one final loose end, and I end with this loose end. To get your revenues from $1 billion to 20 to 40 billion would require not just sweat and tears, but also reinvestment. And I'll tell you, this is where I got stuck when I first started valuing young companies. I tried that reinvestment times return on capital. You know what that looks like for Amazon? It's a big negative number for reinvestment rate because the denominator is negative, and a big negative number for return on capital. You're saying this is very convenient. Big negative multiplied by big negative makes it big positive. But you take a loss and grow it, it just becomes a bigger loss. So finally, I said, why am I looking at operating income? It's revenues that are driving the growth rate. I'm going to tie my reinvestment to revenues, and hence was born the sales to capital ratio. I said, I have to tie how much you reinvest to revenues. And to get that number, I looked across retail companies, and the sales to capital ratio across retail companies was about 3, which means for every $3 in additional revenues, I need to invest $1 in capital. You know, the advantage of doing this, instead of forecasting CapEx and working capital and acquisitions, is I don't know what Amazon will have to reinvest. It's too young a company. Jeff Bezos did not know in 2000 what he'd have to reinvest. When in doubt, consolidate. That's why when I do my young company valuations, I actually have fewer line items than with larger companies because there's so much stuff you don't know that sometimes aggregating gives you a better shot. So when we start on Monday, I'm going to take those assumptions, play them out as cash flows, and then talk about things you can learn from this. You're valuing young companies. Email.